Finance, the process of raising funds or capital for any kind of expenditure. Consumers, business firms, and governments often do not have the funds available to make expenditures, pay their debts, or complete other transactions and must borrow or sell equity to obtain the money they need to conduct their operations. Savers and investors, on the other hand, accumulate funds which could earn interest or dividends if put to productive use. These savings may accumulate in the form of savings deposits, savings and loan shares, or pension and insurance claims. When loaned out at interest or invested in equity shares, they provide a source of investment funds. Finance is the process of channeling these funds in the form of credit, loans, or invested capital to those economic entities that most need them or can put them to the most productive use. The institutions that channel funds from savers to users are called financial intermediaries. They include commercial banks, savings and loan associations, and such non-bank institutions as credit unions, insurance companies, pension funds, investment companies, and finance companies. Three broad areas in finance have developed specialized institutions, procedures, standards, and goals: business finance, personal finance, and public finance. In developed nations, an elaborate structure of financial markets and institutions exists to serve the needs of these areas jointly and separately. Britannica quiz. Financial crisis of 2007-08. Business finance is a form of applied economics that uses the quantitative data provided by accounting, the tools of statistics, and economic theory in an effort to optimize the goals of a corporation or other business entity. The basic financial decisions involved include an estimate of future asset requirements and the optimum combination of funds needed to obtain those assets. Business financing makes use of short-term credit in the form of trade credit, bank loans, and commercial paper. Long-term funds are obtained by the sale of securities, stocks and bonds, to a variety of financial institutions and individuals through the operations of national and international capital markets. Personal finance deals primarily with family budgets, the investment of personal savings, and the use of consumer credit. Individuals typically obtain mortgages from commercial banks and savings and loan associations to purchase their homes, while financing for the purchase of consumer durable goods, automobiles, appliances, can be obtained from banks and finance companies. Charge accounts and credit cards are other important means by which banks and businesses extend short-term credit to consumers. If individuals need to consolidate their debts or borrow cash in an emergency, small cash loans can be obtained at banks, credit unions, or finance companies. The level and importance of public, or government, finance has increased sharply in Western countries since the Great Depression of the 1930s. As a result, taxation, public expenditures, and the nature of the public debt now typically exert a much greater effect on a nation's economy than previously. Governments finance their expenditures through a number of different methods, by far the most important of which is taxes. Government budgets seldom balance, however, and in order to finance their deficits governments must borrow, which in turn creates public debt. Most public debt consists of marketable securities issued by a government, which must make specified payments at designated times to the holders of its securities. Whether you are thinking about starting a business, or you are already in the early days of running your small business, you might be thinking about finances. After all, it is difficult to get a business off the ground without investing money into it. So, why is finance important in business? In this article, we will talk you through the importance of business finance, as well as some of the types of business finance available to both small and large businesses. The importance of financing your business. It is not a secret that every business needs money to operate. Whether you are running a service-based or a product-based business, you'll need capital if you want to make a profit. You may choose to self-fund your business, or you may need to turn to external funding methods to finance your business such as grants, loans and credit. However you choose to finance your business, there's no denying that finance is critical to the success of a business. But why is finance important? Read on to learn everything you need to know about business finance. What is business finance? Business finance is the money that is available to a business. Whether you are starting a new business, expanding an existing business or developing new products, finance will be at the core of every business function. It isn't just changes within your business that will require finance, either. Even just the day-to-day running of a business requires a constant stream of finance, from the cost of marketing to the cost of employing staff. This finance will often be generated through revenue, but at the start of a new business, or if you run into difficulties, you may need to look into other options to finance your business and keep it running. How to finance a business. If you need additional finance for your business, you may be looking into finance options. There are two main options for financing a business: debt and equity. Debt involves borrowing money from another institution, such as a loan or mortgage. This money is then paid back over time, along with interest incurred. Alternatively, you may choose to finance your business with equity. This involves selling shares of your business to investors. The shareholders will then own portions of your business according to the size of their share and may receive dividends according to your profits. Let's take a look at some of the types of finance available to businesses. Short-term finance. Short-term finance is a type of finance which covers a short time period, which is usually less than 12 months. This type of finance allows businesses to raise money quickly and attracts a low interest rate. However, the amount of money that can be raised is small and can directly impact the business. Types of short-term finance include 1. Invoice factoring. 2. Trade credit. 3. Credit cards. 4. Business overdrafts. Medium-term finance. Medium-term finance involves finance methods which typically cover a period of between 3 and 5 years. These types of finance involve more risk than short-term financing methods, but less risk than long-term methods. Types of medium-term finance include 1. Startup loans. 2. Preferred shares. 3. Lease finances. 4. Business loans. Long-term finance. Long-term finance is designed to help a business to grow and expand over time. This type of funding typically has a period of over 10 years and is the riskiest type of business finance. However, it is also the type of finance that will allow a business to raise the most capital. Types of long-term finance include 1. Commercial mortgages. 2. Equity capital. 3. Retained profits. 4. Shares. Thanks for watching, kindly subscribe, and like the video.